Hello, good evening to all of you. Today I would like to discuss the next chapter of financial management under times value of money, that is leverage. As you know, leverage comes from the word lever, and lever means lifting heavy objects from one place to another place. You have already seen, just you see in the blackboard, there is one crane. You know the work of crane? Crane is lifting the derailed vehicle from the ditch to road. So, what do you think on the derailed vehicle or anything? There is already some pressure existing, but that pressure is not sufficient enough to lift that derailed vehicle from derailed position to the proper position on road. It means what? It means the derailed vehicle, derailed things need some extra pressure so that you lift the heavy through some heavy machines, that is crane, and in this way you lift from like this one and lift the heavy crane from ditch to road. So why I'm discussing about the crane? Because the crane is putting some extra pressure. So with the help of some extra pressure, you are lifting. It means in the business, suppose I have only 1 crores of rupees, but I need 5 crores to start the business. That is, fund requirement is 5 crores. So how could it be possible to start the business? It means we need some external financial assistance, like we need the crane. So the crane, in which it is 4 lakhs of rupees of pressure loaded, when you will take the external financial assistance of 4 crores of rupees, then only you can start the business. It means the crane, the external assistance of 5 crores, then only you will get 5 crores plus 4 crores plus 5 crores, and then you can start the business. It means this leverage means the process through which you can start the business by adding external financial assistance along with your own capital, having fixed charges and fixed cost. It means the capital for which you are paying fixed charges, and that capital which you are paying fixed charges, that is external financial assistance, and for which you are paying fixed cost, it means your organization is levered organization. Why? Because the organization is paying fixed charges as well as the organization is paying fixed cost. Then what does it mean? It means if the organization is neither paying fixed charges nor paying fixed cost, do you think that organization is not levered? Yes, certainly yes. The organization is not levered because the organization is neither taking any external financial assistance nor the organization is paying any fixed cost. It means the organization who is paying fixed charges as well as fixed cost, that organization is only called levered organization. Now, levered organization, leverage are classified into three types. Number one is financial leverage. Number two is operating leverage. And number three is combined leverage or composite leverage. Now the question is, what is financial leverage? Name itself is financial leverage. It means you are using the crane which is loaded with fund, that is finance. You need external financial assistance. It means when you are, in addition with owner's capital, if you are using external financial assistance, having fixed charges only, that organization is called financially levered organization. It means financial levered organization are those organizations which is paying fixed charges. It means that organization is taking external financial assistance. For that external financial assistance, the organization is paying fixed charges. Fixed charges means what? Either in the form of fixed interest or in the form of fixed rate of dividend. It means if you procure the fund through bank, as well as if you are issuing preference share capital, it means you are paying interest at fixed rate, as well as you are paying dividend at fixed rate. And these fixed rate of dividend and fixed rate of interest is known as fixed charges. Is that clear? So how you calculate financial leverage? Financial leverage you calculate as EBITDA over EBT. I have already discussed you in my previous class that out of the total earning, that is EBITDA, earning before interest, tax and dividend, the first liable person to whom you want to pay, that is bank interest. It means from EBITDA, first of all you have to pay interest. After that, you have to pay tax. And after paying tax, you have to pay dividend to the preference shareholders at fixed rate. That is D. So from EBITDA, when you deduct I, the amount will become EBTD. Thereafter, you have to pay tax T. Thereafter, D. But when you calculate financial leverage, then you are not only paying interest before paying tax, but you are paying interest, that is I. After paying I, interest, you have to pay dividend. But as a rule, you have to pay dividend to the preference shareholders after paying tax. But if the dividend rate is suppose 10%, and if the interest rate is 50%, then how much you pay to the dividend holder? Because after paying tax, you are liable to pay 10% to the dividend holder. Suppose you took 1 lakhs of rupees by issuing preference share capital. The rate of dividend is 10%. It means 10% of 1 lakh you have to pay 10,000 after paying tax. But if the corporate tax rate is 50%, and now dividend, though which you are paying after tax 10%, now here you have to pay before tax. Then how much you pay to the dividend shareholders, so that the dividend shareholders will get 10,000 rupees, which is 10%. Obviously, you have to pay double, that is 20%. Because you are paying before tax. So when you pay 20% to the preference shareholders dividend, and after that, if the preference shareholders will pay tax at the rate of 50%, so 50% of 20% is equal to 10%. He will get 10%. So, to calculate at the time of computation of preference share capital, financial leverage, the computation formula is EBITDA over EBT, that is earning before interest, tax and dividend, divided by earning before tax. It means I and this D is disappeared. It means you pay. So you pay I and D before tax over taxable income, that is EBT, earning before tax. So when you calculate EBITDA over EBT, in this way you calculate preferential leverage. Suppose, so if I will pay, first of all, if I will discuss the comparison between the financial, operating and combined, thereafter I will discuss further. So financial leverage is that leverage for which you have to, when the organization is paying fixed charges. It means what? It means if the organization is financially levered, there is one risk also, and that risk is known as financial risk. Next one is, I already told you that leverage is a process in which you are paying fixed charges and fixed cost. And fixed cost incur only when the organization starts operation. If the business starts only when the owner will give you employment, And if the organization will give you employment, it means the organization will pay you salary, and salary is fixed. If the business will not operate, it means the organization will not pay you any salary. It means there is no fixed cost. There is no, you don't need to hire a house on rent. No fixed cost. So fixed cost starts only when the organization starts operation. It means this type of leverage is known as operating leverage. It means operating leverage is leverage in which the organization pays fixed cost. And this, again, there is risk because you are paying fixed cost, and that you have to recover. Otherwise, you will be in loss. So this type of leverage, this type of risk is called operating risk. It means this type of leverage is operating leverage, having fixed cost and covers operating risk. Financial leverage, having fixed charges, covers financial risk. And the third one is known as combined leverage or composite leverage, which covers both risk, that is financial risk, and as well as operating risk. Here is what operating leverage is: leverage having fixed cost. So how you compute financial operating leverage? Operating leverage you can compute as contribution over EBIT. Contribution over EBITD. And contribution is what? Contribution is, as you have already, you know that when the business starts, the total sale is equal to total cost plus profit. And you know total cost is equal to fixed cost plus variable cost and plus profit. So, first of all, to reach the profit, how you calculate profit? From sale. If suppose you sell a piece of pen at the rate of 10, and suppose your profit is 2, how you will get 2 profit? So from sale, what will be the process through which you will get profit as 2? Suppose per unit selling price of pen is 10. So 10 is selling price. First of all, from selling price you have to deduct variable cost. Suppose variable cost is 6. So when you deduct variable cost from sale of 10, the remaining is 4. From 4, this 4 is what? 4 is fixed cost and profit. Is a combination of fixed, because in sale is what? Variable cost plus fixed cost plus profit. From 10 variable cost you have deducted 6. So now the remaining 4 is fixed cost plus profit. Suppose fixed cost is 1. And this fixed cost plus profit is known as, term is known as contribution. Contribution is the sum of fixed cost plus profit. So from contribution, Now the second term is you have to deduct fixed cost. Because contribution is fixed cost plus profit, so you have to deduct fixed cost. Suppose fixed cost is 1. So or 2. So from 4, you should deduct 2 fixed cost. The remaining 4 minus 2 is 2. And 2 is what? Profit. Is that clear? So, this profit 2 is nothing. This profit 2 is EBITDA. Is that clear? So, in this operating leverage, how you calculate operating leverage? That is contribution, that is S minus V over EBITDA. That is S minus V minus F. S minus V, that is contribution. And what is this? Fixed cost, having fixed cost. So from contribution, if you deduct fixed cost, then you will get profit. Is that clear? So, here is what? Here, contribution is suppose 6 and EBIT is how much? EBIT is suppose 2, because 10, sale is 10, variable cost is 6, contribution is 4, fixed cost is 2, profit is 2. Okay, so 6 by 6 is contribution and EBITDA is 2. So your operating leverage is 6 over 2, that is 2 2s are 4 and 2.66. So your operating leverage is 2.6. Is that clear? Now, composite leverages. Composite leverage is covering financial risk and operating risk. It means composite or combined leverage is the multiplication of both financial leverage multiplied by operating leverage. Financial leverage is EBITDA over EBT. Operating leverage is C over EBITDA. So EBITDA of financial leverage and EBITDA of composite leverage cancelled each other. Then what remains? Contribution of operating leverage as well as EBT of financial leverage. So composite leverage or combined leverage is the relationship between contribution and EBT. Is that clear? So financial leverage is covering fixed financial risk, operating leverage is covering operating risk, and combined leverage is covering both, that is financial risk and operating risk. Financial leverage covers one who pays only fixed charges, operating leverage pays fixed cost, and combined leverage or composite leverage pays both fixed charges and fixed cost. How you calculate financial leverage? It is written already here. EBITDA over EBT. Suppose EBITDA is 4 and EBT is 1. Okay. EBITDA is 4 and from EBITDA you deduct I and D, and after deducting I and D, if the remaining EBT is 1, it means financial leverage is 4. What does it mean? It means if 1 rupees of 1 rupees increase in EBITD, your EBT will increase by 4 rupees. Is that clear? So if the EBITD will increase by 1 rupees, your EBT will increase by 4 rupees, 4 times. It means if the EBITD, operating profit, will increase by 100%, your operating leverage, your EBT will increase by 400%. Is that clear? It means if EBITD will decrease by 25%, your EBT will collapse. Your EBT will become 0, 100%. Is that clear? Suppose it means what? If financial leverage is high, it will have more financial risk. Risk is very high. Like if suppose financial leverage is 10, say. If financial leverage is 10, it means what? It means if EBITD is increasing by 1 rupees, your EBT will increase by 10 rupees. But if EBITD will decrease by 10%, your EBT will decrease by 100%. Is that clear? It means if you are selling 10 bottles of Nurani Tel, but now if you are selling 9 bottles, if you are not selling 1 bottle, the price of which is suppose 1 rupees, your total EBT will collapse. You will lose your EBT 10 rupees. It means higher the financial leverage, higher will be the risk, financial risk. Lower the financial leverage, the financial risk will be low. Suppose if the financial leverage is 1.1, it means if the EBIT is increasing by 1 rupees, your EBT is increasing by 1 rupees 10 paisa. Very less. Very less. It means financial risk is very less. But if the financial leverage is 10, it means if the financial EBITD is 1, your EBT is 10 times. If EBIT will fallen down by 10%, that is from 10 to 9, your total 10 rupees will collapse as EBT. So very risky. Now come to operating leverage. Suppose operating leverage, so this is what degree? That is, degree of financial leverage is what? Percentage change in EBT over percentage change in EBITD. So how much change in percentage change in EBITD? Suppose 100%. So how much percentage change in EBT? 400%. So risk is increasing. So if the percentage change in EBIT is suppose 1 and percentage change in EBT is 10, it means what? The risk is very high because degree of financial leverage is 10. Very high. If the EBITD is increasing by 100%, your EBT will increase by 1000%. If EBITD if decreasing by 10%, your whole amount of EBT will collapse. You will lose. So this is risky. Is that clear? Now come to next. Here I will show you. Now you see. Suppose there are three options. One is A, second option is B, third option is C. First option, the organization is paying nil interest, no interest. B, the organization is paying 20 rupees interest. And C, the organization is paying 40 rupees interest. After paying 40, 20 and nil, EBT will be how much? EBT will be 1000 in first case, 980 in second case, and 960 in third case. Now, deduct tax 50%. The 50% of 1000 is 500. 50% of 980 is 490. 50% of 480 is 960 is 480. So EBD will be 500, 490 and 480. Now suppose you did not issued preference share capital. So there is no question of to pay preference dividend. So dividend is nil. So EAITD will be 500, 400, 90 and 480. So now you see the EPS, earning per share. It means impact on financial leverage. Because if the financial risk is increasing or decreasing, how it puts impact on your earning per share. In first case, you are not paying any interest. It means neither you are paying interest nor you are paying preference dividend. It means this organization is not paying any fixed charges. If you are not paying fixed charges, it means you are not financially levered organization. It means your financial risk is zero. Now you see here. In first case, EBITD is 1000. And EBT is also 1000. So EBITD divided by EBT, financial leverage is 1. So if the leverage is 1, financial leverage is 1, it means the organization is not financially levered. Is that clear? It means the organization is not financially levered because the organization is not having any fixed charges. It means the organization has not taken any external financial assistance. And in this case, your earning per share will be how much? Earning per share is EAITD, because you have, from the earning you have already paid interest, you have paid tax, and you have paid preference dividend. It means all fixed financial charges you have paid. So after paying all these financial charges, the remaining earning will be distributed among the equity shareholders. So the remaining earning is 500 divided by how much equity shares you have issued. Suppose you have issued 5 equity shares. So 500 divided by 5 equity shares, number of equity shares is 5, then earning per share is 100 rupees. So earning per share is 100. Is that clear? So your financial leverage is 0. If you did not paid any fixed charges, in this situation your organization is not financially levered and your earning per share will be lower. Why? You have only issued equity shares, and you have issued equity shares, it means number of equities is more, and number of equities is more, it means earning per share will be less. Like, suppose one story is there. If a father has 5 sons and 5 houses. How much each son will get share after the death of the father? Each son will get share of 1 house. But if the father has only 1 son, but the father has 5 houses, then the single son will get 5 houses. Here is what number of share is low. That is the reason 1 son will get 5 houses. Earning per share is high as compared to 5 son, number of share is high. So per son, per shares will be less, 1 share, 1 house. Now come to B's example. In B example, the organization is paying interest, 20 rupees. It means the organization is obviously fixed financial levered because the organization is paying fixed charges. So in this situation, EBITDA is 1000, but EBT is 980. See, EBITDA is first case, एक case, EBITDA is 100,000 and EBT is also 100 because interest is nil. So 1000 over 1000 financial leverage is 1. So organization is not financially levered. In second B situation, EBITDA is 1000 but EBT is 980. It means financial leverage is more than 1. That is, financial leverage is more than 1. 1000 divided by 980. Because preference shares dividend is you are not paying. So here financial leverage is increasing from 1 to 1 point something. It means the organization is financially levered because the organization is paying fixed charges in the form of interest. And how much interest you are paying? 20 rupees. So because you are paying interest, it means you have taken external financial assistance. It means obviously your assistance from owner's capital will decrease. Number of equity will decrease from 5 to suppose 3. So 5 to 3, then how you calculate earning per share? In first case, EITD is 500, but in second case, EITD is 490. Divided by number of equity, first case is 5, but in second case, number of equity is 3. So 490 divided by 3, here earning per share is 163.33 paisa. See, number of equity is decreasing, so earning per share is increasing from 100 to 163. Now come to third case. See, third case earning per share, financial charges is increasing from 20 to 40. Dividend is nil, preference dividend is nil. Okay, fine, no problem. Fixed charges you are paying more than B. Obviously, the risk is increasing from 20 to 40. Obviously, the amount of external financial assistance is increasing. It means number of equity obviously is decreasing. Without calculation, you can say that. Obviously, in this situation, financial leverage will be more than B. So 1000 minus 40 is 960. So in this C situation, EBITD is 1000, but EBT is 960. So when you calculate 1000 by 960, that will be more than 1000 divided by 980. It means financial leverage is higher as compared to B and A. Then what about EPS? EPS will be EITD is 480. In second case, B is 490. In third C situation, 480. In B situation, number of equity is 3. In C situation, obviously the number of equity will be lesser, that is 1. It means your earning per share will be 480. It means your earning per share will be higher because number of brothers, number of equity is decreasing because financial charges is, fixed charges is increasing. Is that clear? So, if the financial leverage is increasing, earning per share will increase. Directly proportional. Higher the financial leverage, higher will be the EPS. Lower the financial leverage, lower will be the EPS. A lower financial leverage means number of equity will increase. And that is the reason why earning per share will decrease. Higher financial leverage will means number of equity will decrease because higher amount you are procuring by taking loans from bank. So when you take more money from bank, obviously you will take lesser money by issuing equity. So number of equity will decrease and so earning per share will increase. Is that clear? This is your financial leverage. Now come to next point, operating leverage. I have already discussed you that operating leverage covers operating risk. Operating leverage pays fixed charges. I have already discussed you that operating leverage is the relationship between contribution and EBITDA. EBITDA is what? EBITDA is contribution, that is S minus V, and contribution is S minus V, and EBITDA is S minus V minus F. I have already told you that operating leverage is the leverage having fixed cost. So from contribution, if the organization is paying fixed cost, obviously C is equal to S minus V, and EBITDA means S minus V minus F. If F is 0, then S minus V divided by S minus V minus 0, that is S minus V divided by S minus V, will be equal to 1. It means what? It means operating leverage if 1, it means the organization is not paying any fixed cost. It means the operation is not operationally levered. Is that clear? So, contribution is equal to S minus V. EBITDA means S minus V minus F. If suppose F is equal to nil, suppose you are not paying, you have not hired any employee to whom you pay salary. Suppose you are not paying any amount as a rent. You have started the business in your own house. It means you are not paying any fixed cost. Fixed cost is nil. So how much is operating leverage in your organization? Operating leverage is 1. Why and how? Because operating leverage is contribution, which is S minus V, divided by EBITDA, that is S minus V minus F. And F is equal to nil. It means S minus V divided by S minus V. S minus V and S minus V cancel. That is will be equal to 1. It means operating leverage is equal to 1. And if operating leverage is 1, it means the organization is not operationally levered. It means if the operating leverage is more than 1, it means certainly the organization is paying fixed cost. So, if the fixed cost is increasing, then operating leverage will increase. Then it is not the good situation, risky. Why? If the fixed cost is increasing, suppose S minus V is 6, and if F is 4, F is 5, then EBITDA is 6 minus 5 is equal to 1. And if 6 minus 5 is equal to 1 and S minus V is equal to 6. It means operating leverage is equal to 6. It means if the sale is increasing by 1 rupees, your operating profit will increase by 6 rupees. It means if the sale is increasing by 100%, your operating profit, that is EBITDA, will increase by 600%. Very risky. So you can ask me, what if operating leverage is equal to 10? Yes, it means the operating leverage is very high. How? It means by increasing 1 rupees of sale, your operating profit, that is EBITDA, will increase by 10 rupees. It means if the operating sale is increasing by 100%, your operating leverage will increase by, EBITDA will increase by 1000%. So if your sale will decrease by 10%, your EBITDA will become 0. Means, suppose if previously you are selling 10 rupees, now you are selling 9 rupees, only 1 rupees you are not selling, 10%, your total profit will be 0. So risky. It means by small drop in sales, the organizations will affect drastically. It is a fatal. So high operating leverage is not at all advisable. Why? Because small drop in sales, the organization will lose everything. The total amount of operating profit will be 0. So now you can question me, in which condition the operating leverage should be high? Difficult. Because suppose the organization's sale is very much fluctuating. Almost all organizations will have. If the organization's sale is very much fluctuating, like wave-like structure, sometimes suppose sale is 1,000, another time maybe sale will become 200, 100, 2,000, 500, very much fluctuating. In this situation, high operating leverage is fatal. Because small drop, your organization will be shut down, because you will lose total operating profit. EBIT will be 0, negative maybe. So then in which situation high operating leverage is advisable? Yes. When the organization sale is steady increasing, not decreasing, steadily increasing, trend is increasing, then in this situation you can say that organization, even if the organization will drop, sale will drop, the organization will not suffer. If the organizations, there is growth in sale, and then if the operating leverage is high, obviously the organization will grow, the organization profit will grow. The organization, if the sale is increasing, suppose 10%, the organization operating profit will increase by 1,000%. Certainly very high. Is that clear? So this is the situation of operating leverage. Here I have written S minus V divided by S minus B, because F is nil, so operating leverage is 1. And if the fixed cost is suppose 90, then 100 divided by 10 is equal to 10, and this is very much alarming, because in this situation the organization will suffer a lot. Now come to composite leverage, that is combined leverage. In combined leverage, organization covers both risk, that is financial risk and operating risk. And in this leverage, the organization pays both fixed charges and fixed cost. So how you compute? You compute composite leverage or combined leverage as operating leverage multiplied by financial leverage, and that is EBITD over EBTD. You just see the board. This is financial leverage, and composite operating leverage is C over EBITD. EBITD cancel, and in this way you will get S minus V, that is contribution, over EBT. Contribution is S minus V over EBT is S minus V minus F minus I minus D. Means you are paying fixed cost as well as you are paying fixed charges in the form of I and D. So contribution over EBT. So in this way, if suppose composite leverage, in combined leverage, if fixed cost is also nil, interest is also nil, preference dividend is also nil, it means neither you are paying any salary nor you are paying any rent. It means you are not paying any fixed charges, fixed cost, as well as you have not taken loans. It means you are not paying any fixed cost. You have not, fixed rate of interest, and neither you have issued preference share capital. It means you are not paying any fixed rate of dividend. It means S minus V divided by S minus V, because F is nil, I is nil, D is nil. So S minus V over S minus V is equal to 1. It means, again, if the composite leverage is 1, it means the organization is not combined levered. It means neither the organization has financial risk nor the organization has operating risk, and that is the reason of combined leverage is equal to 1. Is that clear? Now come to I have already discussed all these three. Now it's okay. Thank you very much. And the next part we will discuss. If you have any problem to understand this leverage, you can ask me question in the next lecture, or you can send me the audio clip or send me the message in the chat box, so that I will clarify, I will solve your problem. Okay? Thank you very much. In the next class I will discuss the capital budgeting part. Okay? Bye-bye.